Mortgage rates are going lower again, but many Americans still can't get their foot in the door when it comes to affording a home, and they're turning to non-traditional methods to get on the property ladder. Unison helps homebuyers with their down payments. In exchange, the company gets a share of the gains if the value of the home goes up when the buyer sells. So far, Unison has invested $3.25 billion under these kinds of deals in 30 states with Citi Ventures and the Royal Bank of Canada as some of its co-investors. Joining us now is Thomas Sponholtz, CEO of Unison. Mr. Sponholtz, welcome. Good to have you with us.
Thank you very much.
What can you tell us? What can you tell us about the kind of returns you have received so far on these investments that you've made, and or is it just too early to tell?
It is definitely too early to tell. The relationship between Unison and the homeowners, very much that of a partnership where we stay together for the duration of the time you live in the home or whenever you choose to buy us out as a partner. So it's a partnership where we win and lose together, and it's a long-term partnership where it's a very patient partnership at the same time, where the duration of it is really completely driven by the homeowner.
How long have you been making these arrangements? And we'll get into some of the details because I know the viewers want to know. How long have you been making these arrangements where you'll put up, say, 15% of the 20% down payment? How long have you been doing it?
For approximately 3 years.
Under 3 years. And so really, you probably don't have many sales yet on which to determine. So what are you modeling then as a potential return?
Now, residential real estate as an asset class is a very steady long-term asset class that it has a very different characteristics when you aggregate thousands of homes. Whereas if you look at the individual risk to the homeowner, it's very interesting in the research we've done, the risk of an individual home is just as volatile as the stock market. So therefore, the basic premise we're making is it might not be a good idea to have 80% of your net worth tied up in one stock called your home.
Mm-hmm. So explain to the viewer how the system works and what you have kind of a sliding scale of the profit cut, the cut of net profits that you take when the home buyer exits the home.
Yeah, I think really the easiest way to think about this is that you need to divide the home away from the property that you're buying. The home is the emotional place where you have your life, your family, and your experiences. And then there's the property, which is the financial asset. And what we're saying is that you should buy the home you want or can afford, but with a financial package where you buy as much as you can, and then you have a partner for the part of the home that you otherwise might not be able to afford or feel comfortable owning. And for that part that you get to enjoy the whole house, but only invest in as much as you feel comfortable investing in. And for that part that you didn't buy, that's where Unison's return comes from. Yet you get to enjoy the entire home for the duration of
I understand that. I'm not sure you understood my question. In other words, if you put down 15% of the down payment money, what is the net profit split at the exit point for you?
All right, let's take a very quick example, and hopefully this answers your question. Let's say in many of these cities around the country, and sometimes to start a home is as much as $1 million. And for that, a $200,000 down payment is required. In that case, your home buyer puts down $50,000, and Unison puts down $150,000. And then we share 50-50 in the future change in value of the house until the time you decide to sell the house. Or maybe 4 years later, after you buy the house, you decide you get a big bonus, and you decide to buy us out and then own the whole house. And that might be in better balance with your economy at that time.
How deeply, Thomas, do you investigate the person's creditworthiness? Because I would imagine if they default, that means you get nothing back at the end of it. And also the home itself and the home's location. Are there certain zip codes, for instance, where you wouldn't go into this arrangement in?
This is principally when we do the research, it's principally on the property, meaning is this a property that we feel that we would partner with a homeowner in investing in. But we're building a nationwide portfolio, so it really is not an exercise of selecting properties, but rather unselecting properties that we cannot price with high confidence. So for example, a 20-bedroom chateau in a neighborhood of 2-bedroom houses, we can't price it, so we don't do that. So we unselect rather than select. And it's very few properties we actually unselect in that
Where
case.
do you sit in the event that Matheson sells the house at a loss, which, based on my record in real estate, is not that far-fetched an idea? What happens if I lose money? That $1 million house, I sell it for $900,000. Where do you sit in sort of the credit structure there? Do you get paid back first?
Yeah, that's a very good question. No, we don't. This is pari passu with the homeowner. So we share in the gains and we share in the losses pari passu with the homeowner. So in the case you just mentioned where the house declines from $1 million to $900,000, since we share 50% in the gain, we also share 50% in the loss. So in the example you gave, that was a $100,000 loss. We also take $50,000 loss, and the homeowner takes $50,000 loss. It is a true partnership, as I mentioned, where the homeowner is in charge of when they buy it and when they want to exit. And then we share according to the percentage that we agreed to up front.
As you mentioned before, Thomas,
Very simple.
You've been doing this for about 3 years. Things have changed in 3 years, clearly, especially with the tax
Correct.
code when it comes to some of the high tax states. And I'm wondering if your modeling has changed how you view those outcomes for the investments that you've made in states like New Jersey, New York, and Connecticut.
We certainly do model it, but keep in mind, home ownership, the typical American homeowner stays in their house between 8 and 10 years. So these are very long-term partnerships. So we really view these tax code changes, for example, as being more near-term influences on the market. But longer term, we believe that the market as a whole is in very good shape. And so we don't think it has a major impact. Of course, it mostly impacts the more expensive properties because that's where the mortgage reduction has a bigger impact.